we always take risks, emotionally, socially, and even financially. For example, you have always ordered brownies for dessert. However, today you decide to try something new, something that you have never tried before. So you might taste it and it actually tastes good and get your money's worth, or it might taste bad and you will totally regret buying it. So the risk is that you buy something without knowing the taste, and the return is the taste that you get. That is the risk and return.
It is also the same when it comes to investing. Risk and return come hand in hand. You cannot have one without the other.
Risk is essentially the possibility that the return we get differs from what we actually expect. On the other hand, return means the gain or losses that we get from that investment. This relationship is what we call risk and return trade-off.
The idea is simple. The higher potential return, the higher risk you need to take. In other words, if you want to earn more, you must be willing to accept the possibility of losing more. Low-risk investment offer low return but come with more certainty. It's a balancing act.
Many investors struggle because they clearly don't understand the relationship between risk and return, and therefore they are unable to find the balance between them.
Now, let us hear the story of Youiy. She had just sold her piece of land for $500,000. She's excited, proud, and a bit nervous. Now, she's asking herself, how can I grow this money without losing it all? First, she looked at a fixed deposit. She puts her money in the bank for a fixed period. When the deposit ends, she gets back her money plus interest. On the screen, you can see line going straight showing return is small but steady. She looks at stocks. This time, she buys shares of a company. At first, the stock price go up. She smiles. Then it goes down. She frowns. Then up again. Then down again. The stock price changed because of many reasons. The company's performance, changes in trade policy, conflicts or political events, new regulations, merger and acquisition.
Finally, she looks at cryptocurrency like Bitcoin. She sees that Bitcoin has been rising quickly. Excited, she decides to put a lot of money into it. At first, the price shoots up. Her account balance jumps. She starts to dream. Maybe I can go on a luxury vacation. But then,
1 hour later,
the market suddenly turns. Prices crash hard. On the screen, the line drops sharply. Her portfolio value falls and falls until she lost a huge part or even all of that money. Now she clearly sees cryptocurrency can offer very high potential returns, but also extremely high risk.
Now let us compare the three options. Fixed deposit had low risk and low return. It is very stable and is suitable if you mainly want safety. Stock carry medium risk with medium to high return, and they are generally better for long-term growth. Cryptocurrency has very high return, but also very high risk and volatility, so you should only invest money you can afford to lose. At this point, she feels torn. On one side, she sees little angel asking to put them all into the fixed deposit, keep them 100% safe, don't take any risk. But on the other side, she sees a little devil encouraging her to put everything into the crypto, telling her imagine how rich she could be if it's double or triple. For a moment, she is confused. Then she pauses and remembers what she learned in her finance class, that she doesn't have to choose only one option. She should be rational, not just following her emotion. She can manage risk through diversification, spreading money across different types of investment. Based on her risk appetite, it could be conservative, where she places more fund on the safest, and balanced, where she tries to fairly spread the allocated portion. Or she can be aggressive, where she invests more on the riskier option. After diversifying, her overall return becomes moderate. Although she can't afford the super fancy overseas vacation, she can still enjoy a nice trip to Siem Reap and feel more at ease, because her money isn't all tied up into one risky bet. In the end, she understands every investment has its own risk and return. What's never changed is this: if you want higher return, you must accept higher risk. This is the end of our video. This is a video for educational purpose only, but we hope it helped you think more carefully about how you invest your own money. Thank you so much for watching.